Well, hello, I'm Nick Sharma. Welcome to this dialogue that we're holding here for the Asia Pacific perspectives on the top upstream issues. Our colleagues around the world recently put out a paper on what are the big upstream issues facing the sector. And I thought I'd bring together some of our colleagues here in APAC to really kind of talk through the relevance to this region. So it's great that we have a great set of colleagues. I'll introduce them. We've got Antonio Di Matteo. He's an executive director within the Asia Pacific Upstream. Rachel Calvert, who's a director within the Upstream Transformation Service. Assis, who works within the E&P Terms and Above Ground Risk, and Rajiv Lala, who is within the Companies and Transactions. So we've got a great diverse set of colleagues. Rachel, I'd like to start with you really. Everywhere we go, we talk about ESG, energy transition. It seems to be the volume or the exponential focus on this has increased so dramatically in the last year. Why is this happening?
Yeah, it's a great question. I mean, there's a lot of trends kind of coming together because we had the Paris Agreement in 2015, which put this, agenda item, which has been on the radar for a long time, up at a new level. But it's really only in the last couple of, year and a half, as we're getting close to the first reporting period for the Paris Agreement, combined with a combination of, natural events and other things that have happened, have really put this on the radar in a different way for the general public. And then very much with governments who are looking at submitting revised and enhanced commitments and are starting to understand a bit more a really big need to plug gaps in their commitments. And this issue becoming much more on the agenda of the finance sector than it has been. So all that's kind of coming together to not just this huge focus on decarbonization and ESG more broadly, but very specifically on energy transition and the role that the upstream sector is going to play in that transition. And that's an interesting focus because the upstream sort of core operations is only 10 to 20% of emissions that come out of the hydrocarbon sector. So even though it's a small piece of the emissions puzzle, it's very much in the radar, under the spotlight at the moment, because these goals that are being made by governments are more ambitious, the need for action is greater, and we have this desire for progress everywhere, really now translating into oil and gas company strategies, the need to transform not just E&P players, but the oilfield services sector as well at the same time, and company and government mandates all emerging and shifting together. So it is very much an evolving landscape. But yeah, I would really point to kind of the sort of initial reporting period on the NDCs being something that really got a lot of people's attention.
And you've kind of raised a myriad of issues here, right? And clearly we're starting to see a lot of portfolio optionality or choices being made. So really a second question to you is then, we've seen the European IOCs take big moves, right? And at least trying to get into the low carbon in a much more aggressive way, and they'll only increase in scale. What does that really mean for companies here? And what kind of things are you seeing?
Yeah, it's really interesting. I mean, I think when you do look at that company landscape and in the government landscape as well, the targets and things are very different. Yes, Europe, both in terms of companies and governments, we see some of these more aggressive targets and strategies. But when we look at the world kind of by categories of producers of oil and gas, we have what we call our import dependent or our net import countries. And they're the next category of producers where you see the more aggressive actions taking place. And that's not, in some cases, that definitely aligns with government mandates. So places coming out of like Japan, Korea, South Korea, and China. In some cases, it's being driven a bit more by companies who are really facing supply security pressures in the region that really open them in another way to this all of the above approach to really meeting energy supply security needs that is very compatible with the energy transition. Supply security and transition really do go hand in hand, and that carries a lot of weight in the region. So you combine that supply security need, you combine the sort of shifting government mandates, and then you also combine the fact that upstream players in countries like Asia are not as big a contributor to government revenues as, say, in the Middle East. And that gives them a lot more leeway to adapt and shift their policies and their approaches than maybe you see in some other regions. So really the message is energy transition for the upstream sector in Asia is going to be bigger and faster than most people expect. And we start to see that coming out in a number of ways.
But, when we talk about fundamental capital, we are in a very constrained environment, right? And if we just take national oil companies, their remits are so widespread in terms of energy security. So Rajiv, coming to you then, can this really happen? I mean, can companies within this region do this dual investment strategy and justify this pivot, given they're not flush with cash and they've got domestic mandates?
Yeah, it's a great question, and sort of continuing what Rachel has said here. So you can divide on the low carbon question. We could divide countries and E&P companies in those countries in APAC in two broad groups. The first group is countries where momentum around low carbon is not with the dominant oil and gas player in that country, because the national policy is still being built around maximizing oil and gas resources, which means in the near term and probably even in the medium term, oil and gas will play a very large role in the national energy mix. And so what is happening in this group is that the non-E&P players are doing the heavy lifting on low carbon activities in this group, while the NOCs remain on the resource monetization aspect very clearly, as well as their capital strategies. And then there is the second group of countries where low carbon has activities have begun to take shape, and with E&P companies and typically the NOC in the lead on policy making as well as capital strategies around low carbon activity. And so where we have the second group going is that E&P companies and their strategies are sort of moving towards low carbon, but not necessarily away from oil and gas. And that distinction does matter. But when compared to advances in places like Europe, with very few exceptions, most E&P companies in Asia are still prioritizing fossil fuel supply over decarbonization and are, for now, allocating capital accordingly. And thus, in that sense, E&P companies operating in APAC are yet to face significant pressure on low carbon, and their work and investments in the area, and this is also for NOCs as well as private companies, their work in that area is yet to achieve significant scale.
Okay. So if we take away the key message that E&P will still be the cash cow that will fund these low carbon investments that will then be standalone sustainable business, then Tony, to you then, we've seen a recovery in oil prices and we've seen some real big spikes in gas prices earlier in this year. What are you seeing on the ground in terms of activity? It's a big region, but clearly, is there some upward in activity in core E&P?
All right. Thanks, Nick. I do want to address two aspects on the E&P activity front. First, we are seeing a gradual recovery in the activities, with majority of the companies specializing and focusing spend on their core basins. Some limited players are also expanding to new areas. There are key exploration wells drilled, and more importantly, some positive results are coming out as well from the region. Focus of the exploration is really on proven play upside, and then there's also lower risk resource growth in existing fields. Near field exploration has been more prominent, with short cycle barrels incorporated in the company's exploration strategies. Now, on the development activities, sanctioned projects are progressing, and companies are beginning to pick up their campaigns in existing producing assets as well. Now, just to highlight a few things, like in Vietnam, ENI recently commenced its exploration campaign in the offshore Song Hong Basin, where it has the large Ken Bao gas and condensate discovery. Another appraisal is being drilled here, and this will be followed by a high-impact well targeting another multi-TCF prospect. If this campaign is successful, there is potential to develop the gas to supply to planned power projects. In Cambodia, first oil production for the country was made by Chris Energy end of last year. Going down to Malaysia, PTTEP has been very active. It has successfully appraised the large Lang Lebat gas discovery, and Lang Lebat could actually fit the needs of the MLNG facility. But then a potential challenge here is monetization is the gas content. Also, Petronas and PTTEP have also commenced gas production for the second FLNG project in the country. In Indonesia, Petronas had an oil discovery in the mature East Java Basin, which could help backfill its current production in that basin. Now, the second aspect I wanted to address, and this is in line with what Rachel covered on the energy transition, we do see an increasing trend of companies pursuing lower capital initiatives that could give them quick wins in reducing both emissions and also costs in their existing assets. Renewed interest has also been seen on CCUS. Australia, for example, we have Santos looking to push FID for the Moomba CCS project, which is aimed to be a storage hub in that area. We're also seeing feasibility studies in Malaysia and Indonesia as examples. Petronas in Malaysia is actually looking at CCS for the big Kasawari gas project, with the M1 field targeted as the main storage site.
So, that clearly shows that, there is some good bright spots, largely gas focused, but good successes that we've seen. This concept of switching gears to kind of concept of license to operate and sell your hydrocarbons. Assis, your group put out a really fantastic paper towards the latter half of last year. And, I'd like you to expand on that, but, if that is the case on having the license to operate and sell your hydrocarbons and energy transition, what does that really mean for governments? And what will be the certain drivers that will accelerate or decelerate those plans?
Thanks, Nick. That is a great question. And I guess some of these points will reiterate what Rachel brought up earlier. But to answer your first question, since the Paris Agreement in 2015, countries are looking to plug gaps between emissions and their climate commitments, especially as a growing number of countries are moving towards more significant near or net zero goals. If we look at trends, traditionally climate action related to energy has focused on the downstream part of the sector, but regulations on upstream emissions are expected to tighten in many countries, and we will see these trends emerge in two types of producer countries. So the diversified economies, which are advanced economies where multiple sectors drive growth, such as Japan and Australia, and also in net importers, which favor lower carbon approaches for end use to reduce import dependence and related cost. But given net importers' focus on energy supply security, this could temper the pace of their emissions reduction. And if we then think about the specific drivers that will accelerate such moves in the region, well, firstly, key energy importers or main buyers such as China and Japan are making net zero pledges, which will drive emissions reductions policies. And another key driver is the policies of key partners and the preferences of key partners, which are trending towards lower emissions. So host governments may need to reinvent the wheel to engage specialists in emissions reduction to help with upstream projects, given that international oil companies have already begun divesting across the region. And of course, the perception and outlook for regional and global demand, supply, and prices will also continue to be important drivers in terms of plans for energy transition.
And just, Rachel, this whole concept of emissions is so broad, right? Governments are going to obviously have started to set targets, and we've seen individual companies within this region set net zero targets. But just for our audience, it would be quite interesting to understand the segmentation of scope 1, 2, and 3, and where are companies really going to have to focus their attention? Are there some wins that they'll be able to execute on?
Yeah, I think, when we talk about oil and gas and emissions, we're talking about, scope 1 being we call it direct emissions. So what's under the control of the company in question. So they either own or they operate, what is creating those emissions. Then you have scope 2, which are emissions from any sort of generation of energy the company buys. So the emissions from their power they buy, for instance, to operate. And then scope 3 is the rest of the value chain. And for oil and gas, that really gets important on the final end, which is the consumption piece where the combustion of the hydrocarbon happens, and that's where you get 70 to 80% of your hydrocarbon related emissions. So scope 3 is where a lot of those emissions sit. And really, when we talk about company strategies at the moment, we see most companies are definitely starting with scope 1 and a bit of scope 2, because that's very much within their realm of control. It's what they own, what they operate, how they power their operations. And that when you get out to scope 3, we do see more and more oil and gas companies bringing in some targets that incorporate scope 3, but those really are coming in decades down the line, and the pathway of how those will be achieved and the technologies that enable that very much remain question marks. Whereas if we look at scope 1 and 2, there's a lot that can be done to reduce those emissions right now using proven technologies that are increasingly affordable. So that you really have your kind of near-term gains in a way in scope 1 and 2 for a host of reasons, from technologies being proven and available through to just control and operational understanding of the assets in question. So that's really, the immediate area of focus for most upstream companies. And we've done, a series of studies, and based on these case studies looking at actual assets, you can reduce your scope 1 and 2 emissions 40 to 60% by asset, depending on the asset, and using a combination of technologies. So, and what those look like, there's no one case fits all. It varies depending on the asset and so on, but there's quite a lot that can be done there. And a lot of those technologies apply, very much for the Asia region as well as other places in the world. They're related to using renewable sources of power, more efficiency around transport and logistics, maybe power from shore in some cases, sort of automated offshore operations. So all that learning is relevant for this region as well. And indeed, this region actually benefits from the fact that a lot of the supply chains to produce some of those technologies are very strong in the region itself.
And so thanks, Rachel. And we spent a lot of time, we spent some time on energy transition, and there's a lot more to talk about this subject. But, hydrocarbons are still, a critical part of the future. And whichever scenarios you look, whether it's internal IHS market or external companies, they all talk about hydrocarbons being key. At times it feels like it's a bit of a broken record, right? Are governments doing enough to attract investment? So Assis, the question is to you, are governments doing enough to attract investment?
Thanks, Nick. Well, first off, to answer the question, I guess, competition has definitely stiffened, not just in the region, but globally, as fewer exploration dollars are chasing more opportunities. Before the March 2020 oil price collapse, we were already seeing host governments make improvements to procedural and contractual terms. India did this to a large extent in 2019. And since the price collapse, we saw host governments introduce a whole new set of temporary changes, with flexibility being the key operative word to retain investors. Under the current uncertain conditions, more definitely needs to be done to retain and attract capital. So we are likely to see more permanent changes materialize across Asia. Malaysia is already leading the way on this through introducing greater flexibility through new contract types, and we are likely to see further changes across terms in Indonesia, India, and others across the region.
And so we talk about quite a few interesting levers that the governments have done, Rajiv. And I'll get Tony to jump in a bit, but there is still a lot of good, mature, well-established infrastructure basins. But are there enough companies now? Given we saw quite a change in competitive landscape, what's going to happen on that front? Is there enough companies in this region that will take that risk on what the governments have laid out?
So I'll break that down into two parts. One is very clearly NOCs will be in the lead, certainly by choice and definitely by design, to backstop any decline in local, private or foreign investor capital in the E&P sector. So that's one part of the story. On the other hand, we are also seeing the re-emergence of private capital in the E&P sector in APAC. And this time it is in the form of smaller, nimbler asset specialists, which are focused on near field opportunities and on supportive E&P regulatory environment that Assis just mentioned, and which are banking on this environment remaining supportive for a very, very long time, probably even permanently. And if the current $70 world persists through 2021, many of these companies may get rewarded for their patience and may even scale up. However, the jury is still out as to whether NOCs and this new form of investor capital will offset IOC exits or subdued IOC activity in many parts of APAC? That is the big question, and it still remains unclear as to this combination can handle and bring in both capital and technology to further extend the monetization of resources that is clearly on agenda for many import-dependent APAC countries.
So it boils down to, companies having that capacity in a current commodity market. I'd like to leave the last question with you here, Tony. Drill bit and development activities, E&P is the lifeblood of our industry. And we've got a lower capital constraint environment through the year, deferred from last year. Do you see some countries kind of really grabbing a chunk of that, given the activities that you're tracking?
All right, thanks, Nick. So countries that are pushing for production growth in the midterm, especially those with established markets that would allow quicker monetization paths, would be where this capital will be spent. And this will be driven by mostly the existing players that are growing their core areas. China would certainly be in this list. With the energy security mandate, the national oil companies will continue to be aggressive in exploring and developing their proven basins, both onshore and offshore. Australia would have more development focus, but there are a few key offshore exploration wells that are planned later in the year. Malaysia has, again, more exploration wells are targeted by the key players this year. Development activities are expected to pick up. We could actually see first production from Mubadala's Pegaga gas field in Sarawak, which will go to the MLNG facility. Now, down to in Indonesia, we could also see an improvement in the activities with Pertamina and also the key IOCs as they are progressing with their plans this year. The country has a very aggressive production target, both for oil and gas, to achieve in 2030, and exploration is certainly a key element to reach this. Now, there's a high-impact well, Rencong 1 by Repsol, which is planned in the deep water portion of the North Sumatra Basin, and this is an area that has generated interest. Rencong 1 will also target multi-TCF resources from an unproven play. If it's successful, it will open up the area for further exploration, and potential development could be a tieback to the Arun gas facility. Now, we're also seeing movements in less active countries. East Timor could see an exploration campaign onshore, wherein the last drilling was 50 years ago. Then Carnarvon is also looking at redevelopment of the Buffalo field following a successful entry of a new partner. So this Buffalo field is offshore. Again, on the lesser active countries, there are also high-impact exploration wells planned this year in offshore Japan by Moiko and also in offshore South Korea by KNOC.
Well, thanks, Tony, and thank you, everyone. I think we've had a short discussion, but I think it does set the basis for more future conversations in this area. Asian companies and governments have a very critical role to play here in energy transition. The company will have to make some pretty significant changes on both the E&P and energy transition story, and of course, the host governments, will be key supporters or enablers of these changes. So, thank you once again. And I look forward to another discussion in the coming time.